Hi. The housing market is showing some signs of a potential change. And in this episode of 2 Minutes on Tuesday, I want to cover a couple of those changes and how they could affect you as maybe a home buyer and also as a homeowner, home seller. And before I begin covering that, I want to tell you that the housing inventory, the number of available homes that are for sale today, is still below the normal levels. And the buyer demand is still higher than normal. So you've got strong demand with buyers' interest in buying, and you've got fewer houses for sale than in a more balanced market. However, mortgage interest rates have increased several times in the last 4 months. And with that increase in rate, it's going to cause at some point a ripple effect. And so anyone relying on a bank or mortgage company to either refinance their home or to buy a home, there's going to be some things you're going to want to take into consideration, and I'll go into more detail. Now, something you may not have thought of is that the bulk of the activity taking place in mortgage companies and banks relating to home loans, the number of refinances has outpaced the number of home sales by a significant percentage. However, with the interest rates going up already this year, they're predicting that the number of refinances gets reduced by as much as 70%, if not more. And at first that sounds like a big number, and some people might argue that's inflated. I don't think it is, and I'll tell you why I don't think it's inflated. The number one reason that people do refinances is because they have a higher interest rate, and by them refinancing, they can obtain a lower rate. Say they're at 5 or 6%, and the available interest rate at that moment where they wanted to do the refi was maybe 3% or 4%. So they could save 1 or 2. And by saving that, they could reduce their monthly payment, or they could shorten the loan term, how many years they owed on their home. They could go from a 30-year loan potentially to a 15 and not adjust their payment much. In some cases, they could get a lower payment if the rate was low enough. And lower meaning they could go from 30-year to 15 and still have a payment competitive to what they paid before or even less. All right, so what's happened though is the interest rates have increased. And because the interest rates have increased a couple times this year, the demand, the need to do a refinance is going to go down a lot. And the reason it's going to go down is if you have a 4% interest rate and the bank is telling you in order for you to refi and get a loan today, it's 5%, you're going the wrong way. What drove the refi market before is it was the idea they could get a lower interest rate. They could cut their payment or shorten their term. They were literally saving money by doing a refinance. If you're at 4% and you call the bank or mortgage company and they say, no, the best we can do for you is 5%, you're not going to, one, shorten your term, and two, you're going to raise your payment. So it just makes common sense. The refinance boom it's getting towards the end, and most of the loans that are in process will still close. But new people exploring refinances, they're not going to get the answer they want from the lender because they're going to say, how much is this going to save my payment, reduce my payment? And the lender's going to say, no, it's going to be higher than what you're paying now. And so there's really not much incentive for the majority of the people to do a refinance when the rates are higher than what the loan is that you currently have with that interest rate. So that's one thing. The only exception to that I can figure is that if someone's going through a divorce and you're buying out your spouse or your ex-wife or ex-husband, there may be an incentive for you to do a refinance to get them removed from the loan. But the reality is when you do that, you're going to end up with a higher rate than what you probably had before. So that's really the only exception that I really see. There's probably others I haven't thought of, but that seems to be the big one. So as the refinance market slows, it really has a positive effect on home buyers and the entire process of getting a home loan. And here's why. The appraisers and the lenders were backed up getting appraisals on properties because there's only so many appraisers licensed to do appraisals, and the amount of requests for appraisals and refinances was massive. I mean, it was record-breaking numbers. And so when that comes to a screeching halt, which we're very close to, the appraisers will be able to get caught up. Their turnaround time, instead of being 2-3 weeks, a month from when they receive the order to get the appraisal completed, they can get back to the normal levels where they can turn them around in, 5 days, 7 days, 10 days. And then that helps eliminate the bottleneck that a lot of the lenders have been experiencing, because most of the lenders that we worked with, they were ready to go. They could get their employment verifications, they could get their checking and savings account verifications, they could get their credit reports, they could get all the things they needed quickly. The one thing they were always waiting on was getting that appraisal turned in. And it's not the appraiser's fault. There was way too much demand and too few appraisers actually doing the work, and they were just overloaded. There was only so many hours in a day, and they could only get so many done each day. So it was never their fault. It's just, it's a situation if they were geared up to do, 10 appraisals and all of a sudden they get 50 dropped in their lap, they're backed up. So that's going to smooth out the process. So the whole pipeline, the flow of how you do a loan, if they're not waiting on that appraisal, then instead of waiting 35 to 45 days from when you want to refinance or purchase, you get it down more in that 25 to 30 days, which is what it was before the refinance boom hit. We'll probably get back to those numbers. So I thought that was very, very interesting. And then also the same thing applies with the title companies. Sometimes it was tough to get scheduled times to do closings because they were so busy doing refis and purchases at the same time. As the refinance business dries up, the schedules of title companies and their closing offices will start to ease up as well. It'll be easier to get those scheduled, and there won't be as much overlap when you go to schedule. We had some title companies that were literally closing in one room and another closing going in another room at the same time simultaneously. They were that busy. So I thought that was interesting and something that would be beneficial. Now, here's another one that is worth thinking about. For any buyer that's in the market that's already talked to a lender and gotten pre-approved in advance, if you've got a pre-approval letter that they did, let's just say 2 months ago, hear me out, you need to contact your lender and get that pre-approval letter updated. And I'm not thinking about changes in your employment or things like that. I'm thinking you were pre-approved for a loan with a lower interest rate back 2 months ago than what the rate is today. So if there's a specific price range in mind you want to buy, you want to know, did your payment go up? How much did your payment go up? Do you have to earn more income to qualify for the home that you wanted to buy? Or are you still comfortable? Because a lot of times the lenders are conservative on what you can qualify for. So, but you do need to get that letter updated, because if you have a letter from a lender that said you were pre-qualified 2 months ago or pre-approved, that letter is really useless today because it's out of date, because the market terms have changed and your ability to get the interest rate they quoted you 2 months ago is non-existent today. That rate is probably not available, so they got to re-qualify you based on the current interest rate. And if the rates go up again, you'll need to get that updated again. Unless you've got your rate locked in and you've already got a house picked out. Most lenders will lock that rate in once you have a contract and you filed your formal loan application. So a little bit longer video today, but I thought it was things that a lot of people aren't thinking about. And if you're not in the mortgage business or the real estate business, there's no reason to think about it until you have a need. So I thought this would come in handy. So I'm Sam Miller, REMAX Stars. Thanks for watching 2 Minutes on Tuesday, and we'll come back to you next week. Have a good one. If you have questions, give us a call, 740-397-7800. Bye.